encouraging assessment coming from the International Monetary Fund this week, saying that the global economy is recovering thanks especially to the growth of China, which it says limited the global economic damage from the pandemic. And here to talk more about the growth of the Chinese economy is Brian Tycangco. He is the senior analyst of True Wealth Opportunities China. Thanks for being here and welcome back.
Thanks for having me, Jessica.
So what do you make of the Chinese growth? I mean, this is the first global economy, major economy, to be growing again after the pandemic.
Yeah, looks like they're going to be growing by, according to the IMF, somewhere between 1.5 and 1.6% this year. And next year, I mean, just you wait, I mean, they're going to be growing by 8.2% according to the IMF. And a lot of this has to do with the way China approached the pandemic, where in the early days, they completely shut down huge parts of the economy. Large cities were totally shut down. An entire province was shut down. A lot of people thought this was like over the top at the beginning. But what you have to understand with China is that their goal was basically to get confidence back. Because without confidence, you will never have a lasting and sustainable recovery in the economy.
You've just come off of a national holiday, and this was really the first test of consumer domestic demand, right, for travel and for goods, because the last time you had a national holiday, you were in the thick in China, not you personally, but China was in the thick of the virus. So what did we learn?
Then this October, first week of October, the National Day holiday, was the first real test of that confidence that I was telling you about. And that really came to light, the way people were confident about going back out. Yes, the figures were still down 20% over last year, but if you think about it, 620 plus million people traveling over a span of 8 days means that a lot of people are confident that they're not going to catch this virus, or if ever they do or someone does, China's going to be able to, or Beijing will be able to, cut this the spread quite fast.
We also had a major speech from the Chinese President Xi Jinping in one of the major manufacturing hubs, Shenzhen, earlier on Wednesday. What did we learn from him in terms of the direction of the Chinese economy, and what signals is that sending to the markets?
Okay, so the gist of the speech, which was held in Shenzhen, was basically expect more opening up from the Chinese economy, expect more reforms, particularly when it comes to Shenzhen, which they want to develop as the Silicon Valley of China. And basically the centerpiece of what they're developing, what's called the Greater Bay Area, which is planned to rival the economies of the Tokyo metropolitan area and the San Francisco Bay Area and New York metropolitan area in terms of GDP. Right now, $1.6 trillion in GDP. They aim to grow this to around 4.6 trillion by 2030. That's only 10 years away. So you're talking about tripling a region's GDP in the next 10 years. So that will be done through a lot of opening up, integration with the international community, opening up of Shenzhen, and making it more like, I think, more like Hong Kong than mainland China.
How did the markets react to that speech? Did we see stocks react to the upside?
Generally, very positive. I think stocks were rising ahead of it, but then over the past 24 hours, there was some sort of profit taking. But hey, China's stock market just hit a milestone. They crossed the $10 trillion market cap level as of, I think, Thursday. That pulled back a little bit. As of Monday, that pulled back a little bit yesterday. But the last time this happened was in 2015.
Yeah, before the stock market crash, right?
Rate of the Chinese stock market then.
Yeah.
22.
And just to put this in perspective, though, we should mention that the S&P 500 is about 3 times that big. So it's still a smaller multiple, but it's a milestone to be sure.
Yeah, but I mean, just look at it. China now, just take the CSI 300 index. The PE ratio of the Chinese stock market is just something like 14. So you are now $10 trillion in market cap and only at 14 times earnings compared to 33, 34 times for the US. And you're seeing, huge moves in opening the Chinese financial sector. You can't help but expect money to come in.
All of this points to some sort of provocative comments we heard from the major investor Ray Dalio earlier this week at the Millikan Institute. He said that he says China is favored to win a standoff with the United States. Obviously, we've had that in trade. Now we have that in technology. We may indeed have that in currency. What do you make of those comments?
I agree with him. I'm not talking. I don't think he was talking about a military standoff, but more of an economic standoff, wherein he highlighted the fact that almost all major economies in the world are debasing their currencies, are racing to zero in interest rates. They're monetizing their debt, and the future looks really bleak for these countries. Whereas in China, it's the total opposite. You have a rising superpower with yields that are realistic. I mean, look, since the pandemic, over the past 12 months, China has only cut its interest rates from 4.2 to 3.8%. And that contrasts with almost 0% in any other developed world economy, major economy that you have today. Plus, you have growth happening now in China taking place. You have exports and imports growing for the first time again this year, for the full year, that is, for the first 9 months. So I get what he says. I mean, the long-term picture really favors China.
Let me ask you about the competitive devaluation. In other words, a lot of countries, including China, are weakening their currency to encourage other people to buy their goods. We're seeing the U.S. obviously lead the way with really pushing down the value of the dollar. Europe is definitely considering doing the same, and the Chinese are doing it. What's your take on that? Do you think there's going to be ramifications for investors, and is there a real risk of a currency war here?
I think it's actually the opposite. China's currency has actually gained something like 4% since the start of the year and 6% from its low point in May. And a lot of that has to do with the difference in yields. You see real positive yields, net of real yields in China, and you have zero yields in the rest of the world. And that's why the renminbi has been gaining. The reason why China's currency has actually declined over the past couple of days or past week is that what they did something. They
removed the risk requirement, right?
They did away with the 20% reserve requirement rate for yuan contracts, making it cheaper for you to bet against the yuan. The last time they did this was in September of 2017. The yuan did weaken a little bit after that, but then it went ahead to strengthen all the way to 6.25 to the dollar in less than a year. So to me, doing away with the reserve requirement is a signal that China is confident that its currency will either continue to appreciate or remain stable, and it will not have any wild swings in the foreseeable future. And that bodes well for anybody who wants to invest in China. It gives you a sense of stability, and that's what investors want.
All right, ever the China bull, as I like to call you, Brian Tycangco there, live for us from the Philippines. Our thanks to you. And if you want to see Brian's content at True Wealth Opportunities China, just hover on the screen now. We'll connect you there. Plus, you can find us on Facebook, Instagram, LinkedIn, Twitter, and of course, here on YouTube. Thanks so much for watching. That's all for now.